Hey there, welcome to the final bar. Today we're going to talk about the S&P off a little bit, and certainly, yesterday was huge strength going into expectations for today with Apple and Amazon, big potential catalysts, but also a lot of the banks reporting, stocks like JP Morgan, which we talked about yesterday, really rolling over and showing some distribution at a key resistance level. The question now, as the S&P nears this long-term key top around 3,600, does it have enough gas to get over the hump? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a very windy Redmond, Washington. Thanks for joining us every weekday after the close for our show as we look at the markets together, reviewing the charts, identifying trends, trying to follow those trends and anticipate trend reversals. My guest today is Jeff Weiss from Clearview Trading Advisors. Jeff's one of my first mentors in the business and taught me a ton about, the value of patience and looking at long-term charts and looking at trend lines and trend evolution. And so it'll be very interesting as the market's sort of approaching all-time highs once again, where that fits into his framework as he's looking at the long-term trends and how they've evolved over the course of the year. There's so many potential catalysts, and I'm often asked, how much are charts helpful around earnings and news events and a new iPhone and the Fed and elections and all these things. And my argument is, can a chart predict what Apple is going to do with the iPhone? No, but can it tell you about people's expectations for that? Absolutely. And I think that's how you need to think of it. And you should understand the fundamentals of the company you're investing in, but you also should have a great awareness of the trends and the momentum and how the investors are treating that stock. And that's what we're going to focus on today and every day on the show. We have some wonderful guests. Jeff Weiss is going to join us in a few moments to give his take on the overall equity environment. Tomorrow, we have Mark Newton from Newton Advisors joining us from the New York area. Next week, on Tuesday, we have Jeff Huge from JWH Investments in Minneapolis. Before that, on Monday the 19th, we're going to record a really special event, the Presidential Cycle Panel. I talked to some of my friends, Bruce Frazier, Tom McClellan, Jeff Hirsch, to do a panel discussion where we'll talk about the presidential cycle, the four-year cycle leading into the election season here. What does that mean for cyclical patterns? What does that mean for the seasonal patterns of the normal year? What tends to happen around an election this time of year and in this part of the four-year cycle? And what does that mean going forward? Where should you be focused? So it should be a really fun conversation. That's coming up on October 19th. So certainly check that out. Getting to our market recap again, there are so many news events happening. And as always, I hope you are finding ways to stay on top of earnings and product launches and all of that sort of thing. It's sort of outside the scope of what we can do on this show. Our goal is to review the charts together because I've often found working with institutional money managers, you have a great understanding of certain things, and there usually are some pockets of weakness in your overall process, some blind spots, if you will. And charts a lot of times are that blind spot for investors. And what I hope we can do together is upgrade that portion of your routine, help you find some signal in all the noise using the charts. So what we're going to do right now is do a market recap. The S&P down 0.6%. Really chopped around a little bit, and a nice rally going into, sort of the 3 o'clock hour. It came off a bit at the close to finish certainly weaker. And really today was really a follow through from yesterday's sell-off going into the close. You can see on just a 2-day little preview chart how we really just kind of continued that trend from yesterday. The NASDAQ actually spent some of the day in the positive. It sort of chopped around the zero line, really finished essentially flat, just down 0.1%, but overall in okay shape. Mid caps and small caps really felt the pain. They were down the most, with small caps down over 1%. And again, still not a climactically bad day, but relative to some of the up days we've had, it certainly feels weaker on a relative basis. NASDAQ 100 flat as well. Bond markets back open today, and the TLT was up 0.7%. This is bringing 10-year yields down to around 72 basis points, 73 or so. Looking at commodity markets, gold really down today, silver as well. So sort of a risk-off day in a lot of ways you might look at it. The dollar stronger, and so that weaker dollar pattern that we've seen sort of in the short term reversing a little bit. So bonds and the dollar up, and most other things down. Looking at the sector rotation, I was on the TD Ameritrade Network this morning. It was asked about just leadership themes, and I think one of the key things to look at on a day like today, do we have that continued presence of the FANG trade, which is what we saw today, right? Yesterday into today is the FANG stocks working more than others. Stocks like Apple, weaker, but overall communication services, consumer discretionary, even consumer staples finished essentially flat for the day. The market was dragged down by financials, by REITs, by energy, sort of these more value-oriented spaces. Financials are a tough one because this is the week where a lot of them are reporting earnings, especially the big banks. We're going to look at JP Morgan's chart in a little bit, but I think the weakness there, if the market is going to get materially higher from here, you'd want to see some of those sectors start to participate in a more positive way than they have been, a little better participation. And we haven't seen that. Now with financials, you're facing some key resistance levels, and days like today sort of solidify the importance of those resistance and drive home how certain stocks have been unable to eclipse their key resistance levels. Let's look at the overall S&P. My general take on things, as we've talked about it, is this 3,200 level really ended up being the line in the sand that held. And I think if and when we get any sort of pullback, I will absolutely be looking back at the same levels we looked at back here in early mid-September, which is first 3,350 to 3,400. That includes a pretty established congestion zone, also the 50-day moving average, which is right here around 3,390. So on any pullback, that's absolutely the first thing to look at. Further than that, 3,200 to 3,250 is really the ultimate level. I think as long as we remain above that in the coming months, overall the trend is in decent shape, and we could chop around here obviously for quite a while if it comes to that. But as long as we remain above there, I think we're okay. If we start breaking below there, that's when you have to really think about potential downside risk and all of that. If you look, and I think what's interesting to know, I've talked about the 3,600 level many times. That's sort of the peak, the intraday peak, the closing peak that we got was just below there. We're right in the range though. We're within the range of the high trading day here, and then you had the big move lower out of the highs. We're sort of right in that spot. So at this point, you can kind of consider it a double top of sorts. And the question is there enough momentum to propel stocks above here? There are plenty of potential catalysts to do so. There are also plenty of potential headwinds, and we're obviously getting into the meat of election season. Millions have already voted here in the U.S., and that is going to continue obviously through early November, and a lot of a pretty contentious environment politically. And so I think there's a lot of opportunity for some fluidity and for some choppiness, to be honest with you. So good time as any, a better time I don't think you're going to find to take a step back and look at the trends. At this point, the trend remains positive, and that pullbacks keep resolving to the upside. We keep making higher lows and for the most part, higher highs. When that changes, that's when we have to start to get a little more concerned. Looking at some other asset classes very quickly here to wrap off our market recap. The bond markets were closed yesterday, so the TLT was sort of a flat, non-story. Today, a little bit of a bounce back higher. And so what you've seen now with the TLT is it's really testing the 200-day moving average. It hasn't gone below it in quite a while. We'd have to go past a year to find the last time the TLT was actually below its 200-day moving average. So overall, even with the sideways environment, it's remained in a secular uptrend, if you consider the 200-day sort of the measure of that sort of thing. If we would break down through the 200-day, that would certainly be a vote of lack of confidence for further upside. Also, you have a trend line. If you connect some of these previous highs, breaking above those trend lines, back above the 50-day moving average, would sort of confirm a rotation back into bonds. But while today the ratio is certainly going to favor stocks over bonds, for the most part, bonds have been weaker on a relative basis for sure. But seeing if we're able to hold these levels, if we get a bounce back to the upside and able to get above really that 165 range, which is that congestion area from August and September, would be pretty key. Looking at the chart of gold, the GLD, it's interesting. Just 2 days ago, we're looking at this chart, and it's all right. We're back above 180. We're back above resistance. This is the all clear sign going higher. problems that I'm seeing now, we've never got above the 50-day moving average. That follow through we didn't get. Anytime you get a breakout, you want a follow through day. You want sort of the confirmation that that breakout is validated. It has further upside. We didn't quite get that. We're sort of back down into this range. So gold, continues to frustrate in terms of its inability to get back above really this main resistance area, which is this August to September period. So you'd want to see, if you're looking for upside, number one, you want to see it remain above these swing lows. If that would break, you look down at the 61.8% retracement level. These are down here around 172, 172.50 or so. If it does recover, you'd want follow through above 180 and ideally above the 50-day moving average. So sort of a holding pattern for gold. It felt like we were getting an all clear, and I don't see that now materializing on the tactical time frame. Long term, the trend is still very much positive, and I think we will eventually see higher highs for gold, but certainly doesn't seem to be the story today. Just to wrap up, I point out there are a lot of movements on individual stocks. We're not going to get a lot of opportunity to review it. Things like Royal Caribbean, Norwegian Cruise Lines all down today. Royal Caribbean had some news related to that with an offering and some bookings information and all of that. So, remember, the chart doesn't always tell you the why, but it tells you the what. Look for stocks that are down a lot, dig into those themes and understand how much the fundamental story, how much the investment thesis may have changed. And make a conclusion based on that. Fox is another one. This is part of that communication services group. So those media names that had started to break to new highs, breaking above the September highs, started to look really constructive. A bearish engulfing pattern from Fox, and now 2 days later, you get a big move lower. So stocks like that failing at resistance and then coming off, the more that happens, the less confidence I would have in a big break above 3,600. But again, as a trend follower, trends going up, I'm going to think upside until proven otherwise. That's our market recap for today, boy. We hit on a lot of different things, but hopefully it gives you a sense of where we're at on a bit of a pullback day after yesterday's strength. We're going to take a quick break. We'll be back with my guest, Jeff Weiss. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. A little later, we're going to have a mailbag segment. We get the content for that from your questions, whatever you run into as you're going through your normal process of analyzing the markets, going through the charts. No question is out of bounds. Please let us know what you're running into, and we'll do our best to answer your question on the air. A couple ways to get your questions to us. One is via email, thefinalbar@stockcharts.com. Number two is on Twitter @FinalBarSCTV, or on our YouTube channel. Just put a comment below the video. We'll capture all of those and hopefully answer one of your questions later in the week. I want to welcome on my guest, Jeff Weiss. Jeff is a CMT from Clearview Trading Advisors, a technical analyst for a number of years and a mentor of mine getting started in the industry. Taught me, Jeff, a ton about being patient and being a long-term investor. And welcome to the show.
Honored again. Thank you so much, David, Gretchen.
So you shared a couple charts ahead of time. And again, when I think of your work, Jeff, I think about a long-term perspective and trying to put the noise of the short-term into the proper long-term focus. So we're starting with a pretty long-term view of the S&P last couple of years. Orient us with what you're seeing here. What's your take on things?
Thank you, David. Thank you, David. Looking at something on multiple angles is really what I like to do after I go through, up to a few thousand charts a week. And I look at it from a number of angles, but one of the angles I always look at it from is a weekly closing angle. And here, friends, you see the Standard & Poor's 500 index on a weekly closing basis, noting that on the far left of the screen, the weekly high back, I believe it was the last Friday of January 2018. That would be the 26th, if I'm correct. And then connecting that with the peak before the, well, fill in the blank, when you rallied off that March low. And that March low was interesting because on the weekly bar chart, you had a positive outside week that week, which you would see if you looked at a bar chart. You had one in March, I believe. You look at that rally to a new recovery high. In fact, Dave, I think that's a new all-time high. Look at that third point within 5 points of the line, just over 3,500. So close to the line. And this is a good example of a premise I believe in, that just because a stock or market is making a new high or a new all-time high does not necessarily mean that there's no resistance ahead. And this week, that line is trading at approximately, on a weekly closing basis, now 35.46, and rising approximately 4.75 points per week. I think it's from my vantage point, friends, a pretty good line, well-defined, well-spaced. I wouldn't be surprised if, we have a little bit of it represents, well, let me put it like this. It represents potential hurdle for the bulls. Even if we get above it on a daily basis or an intraday or an intra-week, I'm going to want to see where the S&P closes on a Friday day.
Got it. And you've always taught me, Jeff, to wait for the weekly close, wait for the Friday close, which is, it's such a great lesson, especially given the turbulence we're seeing. Now, chart number 2 is looking at the NASDAQ composite. How do you relate that to the first chart we were looking at?
Well, I think the keys on the NASDAQ is that after it got above the the highs representing the two downward pointing arrows, that after it broke out above that, that third arrow represents a successful test. And then right next to it, Dave, there's another little low. I should have put probably an extra arrow in there, maybe. That would have been another low. So you basically have two highs spaced well apart and two lows within days of one another. And then, of course, we approach the area there. You could see where Dave is circling again and held. Now, when that held and we started up, I think that also helped the market. And of course, the daily advanced decline line, cumulatively speaking, and the cumulative weekly advanced decline line, both on the New York Stock Exchange, are giving fairly good counts of themselves. And again, that's another, has been another, I believe, market aid.
Now, in this environment, obviously the leadership of technology has been undeniable, but the question a lot of people are struggling with is small cap versus large cap and participation from the small cap space. Your last chart's the IWM, the Russell 2000 ETF. What are you seeing here?
Well, I like the fact that we've been able to close convincingly above the 157, 158 range, David, where we have four actually down arrows. You'll notice in that August period, and possibly late August, early September, where that second downward arrow is the ones that are close apart. Dave, if you want to just zoom on in on them, there you go. We failed, and then we came right back above it. Now, there's also a pattern kind of similar to that in the value line arithmetic index, which attempts to look at how a typical portfolio performs. And that has also gotten above a horizontal line. So this is an example of prior resistance now becoming potential support, which is basically a technical analysis rule. Former potential resistance now becomes potential support on the way down. And that's again, a reason I think where the market has had staying power. Lines have been overcome. We've had positive outside days. We've had upside gaps. And then to top it off last week, we had rallies and finishes above lines like the one we're displaying here on the iShare Russell 2000 ETF.
Jeff, 3 solid charts, and thank you for reminding everyone the value of taking a longer-term perspective, looking at some of these longer trend lines and where the opportunities are. Hope you and the family stay safe, and we'll talk again soon.
David,
right?
to everyone out there, only the best, health before wealth, and only good things. And my continuing thanks to StockCharts.
Appreciate it, Jeff. Be well, all right? That was Jeff Weiss from Clearview Trading Advisors. Jeff, as I mentioned, I hope we can have Jeff back for a longer conversation. He's just a fascinating man with a great point of view, and I learned a lot from spending time with Jeff. And you know, when I first met him, we would be printing charts out, or he would be printing charts out with the pencil and ruler, and just driving home, I would get so excited about these short-term moves, and he would say, look, until Friday's close, nothing happens, so don't get so excited about these little movements. And I've kept many of those lessons with me through today. So thanks, Jeff, for coming on the show. Let's get on to our next segment, which is the final bar mailbag. One of my favorite parts is to hear from you, answer your questions as best as I can to focus on the key questions crossing your mind. Let's get to question number 1. Do you have a daily checklist of basic characteristics that might interest you about a stock? It's a really good question. So I actually do have a checklist, and boy, had I thought ahead of time, I would have been able to bring it up. I don't think I'm going to be able to immediately, but I will tell you what, so for me, when I've taught technical analysis at the college level, and I taught at Brandeis University for a number of years, I took it over there from Charlie Kirkpatrick, who wrote one of the classic texts now, I think the modern classic texts on technical analysis, which we use as our rating. And then David Lundgren from Wellington took over the course from me after I wrapped it up. But it was fascinating to talk and teach technical analysis to second-year master students. I feel like half the semester was spent unwinding what they had learned about efficient markets theory and modern portfolio theory and all these things, and just to focus on the message of the markets, the information that is present in the charts, because it speaks to the behavioral biases that drive a lot of investment decisions. Having said all that, do I have a checklist? Absolutely. And I will tell you, the way that I describe charts, the way that I bring it up really implies the checklist that I go through. It starts with trend. It really starts with the Dow theory. And what I always have people start with is this chart in an uptrend or downtrend? So whatever time frame you're looking at, here we're looking at a daily chart of Apple. Is the stock in an uptrend or a downtrend? And that's the way you do that, is by looking at the highs and the lows. Are the highs getting higher? Are the lows getting lower? And whichever one of those happens on the time frame you're looking at, that is the trend. That's how it starts. And until you can answer that question, all the other questions are relatively meaningless. After that, it goes to trend. Are we at any key trend lines? Have we broken any key trend lines? What about key support and resistance levels? Where are we at relative to important levels on the chart? And what lines could you draw to identify support and resistance? Any price patterns like big base breakouts or triangle patterns or flag patterns, or something that might help inform the characteristics of the trend. Other things would be what I call confirmation, which would be things like RSI and volume. Other ways to sort of qualify what you saw on the price, which is the most important, but what other ways can you make sense of things? And then it gets to relative strength, which would be the most important question for an equity tool or an equity evaluation, which is, how is this chart relative to all the other charts that I could look at? That process, that checklist, is something when I'm teaching technical analysis, I have people start at the top and build that checklist over a semester and answer each of those questions. My checklist may be different than yours, and I'm thinking maybe one of the future shows we do, maybe we can focus a little bit more on that checklist, and I can illustrate some specific examples for you. But that is absolutely, the question number 1 is absolutely, the answer is I do have a checklist. I would encourage you to develop your own. I think that's one of the first questions you need to answer as an investor. Question number 2, I heard recently that StockCharts added VWAP to its collection of tools. Could you go over how you use VWAP in your analysis, please? So I will show you what it is. Brian Shannon created this indicator called anchored VWAP, which is basically, a VWAP, which is volume weighted average price. So it's basically looking at an average price over a period of time, but it's weighted by the volume. And it's a common way during the trading day, when I was first introduced to VWAP, I was working with traders, a lot of buy-side traders that would be evaluated based on their ability to beat the VWAP, which is basically over the course of the day, we're able to get a better fill relative to the average price weighted for the volume of the individual trades. And that was one of the really simple ways you could evaluate trader performance. The way you do it is in our ACP platform. This is basically an indicator called Anchored VWAP. You can see it on the left here. When you click it, it's going to add it. You can actually manually enter the timing and how you're going to do it, or you can click on a particular price point. So here I'm taking Electronic Arts, I'm clicking on the high day and basically saying start the VWAP there. And what it's doing is it's building the data over time, and it's giving you the weighted average price relative to the data that you bring up. And what you'll find a lot of times is that the price will tend to trade around these key levels. With Electronic Arts, I was looking at this earlier today. That was really interesting how in late September, early October, we bumped right up to that VWAP line. It came off. Today, we're just closing right at it, potentially breaking above it. So it's a really interesting way. It's sort of a dynamic moving average is how you may want to think of it, because it adjusts more to the actual trading environment. Brian Shannon, who's a CMT, created this indicator a number of years ago. He's actually going to be coming on my show, and we're going to do a special with him for him to explain exactly how he used that. I would encourage you to check out that video when it comes out. Dave, in your last final bar video, you showed a chart with different asset classes, IWM, TLT, et cetera, expressed in percentage. How did you do that? Yeah, good question. So I'm sorry for the very crude version of what I'm about to show you. But basically, I have a set of charts, and I'll show you what they are. This is in crude, unedited form, but you can get a sense of what I'm doing here. This is the intermarket chart that I showed you. The labels are a little off because I haven't updated this, but basically what this is doing is I created a chart of the S&P 500. The type of chart is called performance. You're usually up here on OHLC bars. I switched it to performance, which starts the clock at the left side of the chart and shows you the percentage performance from the starting point to where you're at today. Then you can add indicators called price dash performance. You can put up to 10 things on here, I think, and just switch position to behind the price. What that's going to do is create this beautiful little spaghetti chart, if you will. It gets very confusing very quickly, which is why I create these labels to sort of make it a little clearer. Talking with our developers about maybe some ways to automate that, but for now, it's a really good way to just visualize it, and you can see the legend here in the upper left to see what you've included. If you want that chart, just shoot me an email, thefinalbar@stockcharts.com. I'll send you a link to it. You are welcome to use it in your own login. That's all the time we have. I always wish we had more time for questions, but we will get to it in our next mailbag segment. Thank you, everyone, for your questions. We need to go to the 3 and 3 charts, 3 minutes. Here we go. Chart number 1 is the consumer discretionary sector, XLY. On Monday's show, we talked about sector rotation as part of our normal 3-pronged approach to sort of market analysis. I think it's interesting to know as the S&P is approaching all-time highs, things like the XLY have already done it. So yesterday, they actually made a new closing high, and then today, again, closed above the previous high from early September. You see the relative strength in consumer discretionary has been pretty impressive. Now, obviously, Amazon is a big weight in the XLY, but impressive just to see the sector as a whole going higher. Its ability, the XLY's ability to break new highs and remain above previous highs is pretty crucial because you need leaderships that are able to trade to push the market higher. That's what I'm looking for there. Number 2, do you have other sectors that are able to join consumer discretionary in this resilient uptrend? Healthcare is one that has not quite been able to do it. Threatened a new closing high yesterday, did not do it. Pulled back just a little bit today, but right now it's literally right near those long-term highs from early September. So sectors like the XLV, like technology, like others, able to break above their recent swing highs and remain above them. The building of momentum with sectors able to push above the previous highs would be pretty key. And we've not seen that yet with healthcare, but that's certainly one thing I would be looking at. The relative strength, by the way, is sort of on a warning list for me, kind of rolling over after a little, what seemed like a really impressive potential breakout there in mid-September has come back down, really with the strength in the other sectors. Finally, we talked about earnings this week, and again, we've got a lot of catalysts, but JP Morgan just coming out today, and you can see a bearish engulfing pattern. So that's an up bar and a down bar, or you might call it a bearish outside day. So a wider range, but a down close that goes below the previous day's open. And so this is essentially a short-term failure signal right at the 200-day moving average. This does not make me feel good about JPM's ability to pop ahead of this and continue to move higher. It's what we talked about, getting above 105 aiming to 112.50, which would be the previous swing high in June, and getting further up there. So that's one thing I'll be looking at. Also interesting to note the RSI potentially failing right at the 60 level, which is actually classic for a bear market environment. Folks, that is our show. Special thank you to Jeff Weiss for joining us from New York today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.